Whether because you don't have enough capital to invest or because you want to leverage your return, a CFD might be the solution for you. First of all, a CFD are the initials of a contract for differences, and it is an instrument that belongs to the derivatives market, meaning that its value depends on some sort of underlying asset, such as a stock, a commodity, and so on. As the name suggests, when you acquire a CFD, you are exposing yourself only to the price change of the underlying asset, instead for having to acquire it later to sell. And one of the main advantages is that you won't need the entire capital to buy a stock, for example, and still get the same exposure as if you owned one. For example, imagine that a stock is currently priced at 1000 euros, but you only have 200 euros on your account. If your broker does not allow you to purchase fractional shares, I mean a part of a share instead of it all, then your only solution is to acquire a CFD that replicates the price movement of that stock. And if you do so, you will now be exposed to the same price changes than someone who really owns the stock. But for obvious reasons, there is usually no place to receive dividends or other types of returns, because you're not truly a shareholder and are only focusing in getting capital gains. Apart from giving you access to assets that would otherwise be unreachable to you, a CFD will also leverage your return, which can be both an advantage and a disadvantage to you. By leveraging your return, I want to mean that with the same amount invested, your potential return increase. But it is also important to note that your potential loss will increase in the same magnitude, meaning that you can easily get a 50% return but also reduce your capital to zero in no time. Let's return to our example to understand this. So now you have acquired a CFD that replicates the price movement of a $1000 stock with only $200 in your broker account. Imagine that the stock is now trading at 1100 euros. If you have acquired the entire stock at 1000 euros, you will get a 10% return if you sold it at this price. But since you have a CFD with only 200 euros, you were able to generate a 100 return, which represents 50% of your capital. So you were able to multiply your return by a factor of 5, because you have a smaller amount of capital but with a higher purchasing power, equivalent in this case to 1000 euros. But let's imagine now that things don't go as planned and the stock moves instead from 1000 euros to 900 euros. Once again, if you have acquired the stock at 1000 euros, you would be now facing a 10% loss, equal to 100 euros. If you had instead acquired a CFD, you would still face a 100 euros loss, but this would now represent 50% of your capital invested, and you could find yourself in serious trouble. These types of instruments are more popular in the forex and commodities markets, where the minimum trading size is often too high. But as you can see, even though CFDs allow you to magnify your exposure to the price movement of a certain asset, it will also multiply your potential losses by the same amount. You don't have any motive to be afraid though, if you define a proper risk management strategy where you set a minimum loss per trade that you are willing to accept, for example as a percentage of your total account. Finally, bear in mind that trading through CFDs and other derivatives markets almost always imply additional costs associated with the need to create a margin account and the money that you are lending from your broker. So make sure that before trading anything, you get all the information regarding the instruments, commissions and other important stuff from your broker. As always, if you have learned something new, please leave your like and comment any ideas you want to see in upcoming videos. See you there!